Hey guys, welcome to this presentation. We're going to be talking about conceptual framework in this presentation, and of course at the top I have the title highlighted in green and red because it is that festive time of year where Christmas and Hanukkah and Kwanzaa and all those other holidays are right around the corner. So I figured we would use some holiday colors to kind of make this a festivus presentation-ness, even though that's not a thing, but I'm making it a thing in this tutorial. And yeah, I'm going to express what conceptual framework is using an analogy to kind of guide you through this with ease. So the conceptual framework is actually this system, and it's like the backbone of the financial accounting system because it helps us decide what is reported, helps us decide what is measured, what is disclosed, how it's presented, and so on. So it's incredibly important, which is why we're covering it this early on in the video series. So let's get right to it. And the first part of the conceptual framework is this little blue ball, and that is our objectives. And our objectives, I'm going to change it to blue. Our objectives of financial accounting, determined by our conceptual framework, is that we're supposed to record assets, liabilities, and equity. Basically our financial position, because of course assets, liabilities, and equity are on our balance sheet, and the balance sheet is basically a picture in time of our financial position. So the objective is to record those three elements. The changes, it's just a delta sign, it's supposed to represent changes in those three elements, and of course the performance of those. So we have our objectives in place, and I kind of want to create this analogy. We're going to say that the first level of this conceptual framework is our society. So our society has some fundamental kind of goals or objectives now. And now that we have these goals and objectives in place, our society is beginning to grow. What we need now is the second part, which is going to be a language. That's what every society needs. We need to be able to basically communicate with each other, and that's the second level of our conceptual framework, because the elements, if you remember the elements, they help us basically report all the transactions within our company, and they allow us to communicate to investors or creditors or different users. Basically, they help us communicate what's going on within the company. So our elements, if you don't remember, they're assets, liabilities. Hopefully it's fine that I abbreviate everything. Equity, revenues, expenses, gains, losses, other comprehensive income, and dividends. Hopefully I didn't forget anything there. I think that's all of them. But yes, our elements are our language to our society, and we express everything using these elements. They're kind of the second level to our conceptual framework. Well, they are our second level to our conceptual framework. And of course, after we have the society in place with our people are now able to communicate and such, well, the third part is going to be this large yellow bubble. I'm going to change the color of my brush. And the third part are the principles and constraints to keep everything in place. So the principles and constraints kind of decide whether things are reported or measured or disclosed or presented. So it kind of encapsulates everything. And it's kind of like the laws to a society, except that we're not trying to make rules in accounting. We're basically trying to use more judgment, or at least that's how it's kind of evolving towards like IFRS standards, if you've heard anything about that. But yeah, they're trying to make accounting more of a judgment-based science, I guess you could say. So what do I mean by laws? Let me give you an example of this. Well, first let me get rid of some of this stuff on the right hand side, because I do not have much space to write anything. Hopefully you can just rewind that if you need to see that information. So to give you an idea of what I mean, let's say to go with our festive kind of situation, let's say we have a company that is selling Christmas trees. And of course they're creating them, or they're not creating them, they're planting them and they're growing, and the season has come to where they cut them down. So of course they initially plant them, they grow, they cut them down, then they kind of put them in their place of sale, and then hopefully they actually sell them, and then sometimes the sale is made on cash or credit, and then eventually they receive the cash if it's a credit sale. So there's many different parts to this business, and for our business we're going to look at these, and how are we going to determine when to recognize revenue? Do we recognize it once we've basically grown the tree, because maybe we're going to sell 90% of our trees? Is that when we recognize it? Should we recognize it once we've actually sold it on cash or credit? Should we only recognize it on a cash basis? This is going to be decided by the principles and constraints, and you'll see that of course one of the principles is the revenue recognition principle, and it's actually going to tell you or give you an idea as to how revenue is earned, so that basically you have to have some idea of the measurability. You got to know how many trees and how much they're worth you've sold. You have to know that collectability is reasonably assured, so that you will most likely get your cash in the end, and that the risks and rewards have transferred, so that you've actually sold the tree and you've received the reward of revenue. So most likely in this case, it's going to be when we sell the tree either on cash or credit terms. So these principles and constraints keep our decisions, or they kind of guide our decisions within accounting, and they can always be reflected on when deciding whether something should be reported or measured or disclosed or presented. And there's many of these principles and constraints, and we're going to learn all about them in future tutorials. But just remember that the conceptual framework is that it includes all three of these levels: the objectives, elements, and principles and constraints. And the principles and constraints basically contain all of this together, so that there is no type of fraudulent accounting. I can't remember if fraudulent is spelled with an A or a U, but whatever. It's fraudulent accounting is outside of the conceptual framework, and certain companies like that are Enron, who have kind of gone against the principles and constraints or have done shady financial practices. I guess Bernie Madoff's Ponzi scheme, that's a more recent one, and Sinoforest, I forget how it's pronounced, but that's a timber company. Actually, it's kind of a good one since we were just talking about timber. They overstated a lot of their assets, which was another fraudulent case. And we'll be talking about all of this, but I just wanted to give you an idea of what conceptual framework is. It's basically what guides us. It's what guides us with these four acts: reporting, measuring, disclosing, and presenting, and it's kind of our system. So hopefully that wasn't too long of a tutorial. Make sure to subscribe, and thanks for watching. If you have any questions regarding accounting or any other material within our videos, you can tweet us at NotePirate. You can like us on Facebook to receive updates, or to share any quick anecdotes about how our videos might have helped. And like always, thanks for watching us on YouTube.